Hey guys, I hope you guys are doing good today. If you bought Apollo tires anywhere near 556 rupees in last October, you have lost literally 23% of your money in just 6 months. But here is the real question. Is this a stock you should be cutting a loss on, or 429 rupees is just a gift? Today, I am going to go through every single fundamental to answer that. The revenue, the cash flow, debt, promoter integrity, and that one quarter that made the stock crash. By end of this particular video, you will know exactly what to do. So please do watch this video fully so that you may get a clear understanding about this particular business and the stock and the performance and all those things. Without wasting any time, we have to get into the video. Before that, if you're new to my channel, please do subscribe it. Let's go. Okay, so let's start how exactly they make money. So they have three buckets. Bucket number one, India's replacement market. So for example, you got a very bad tire. Obviously, you may hit to the tire shop. That particular shop, obviously, they may stock Apollo tires. This is actually 55 to 60% of their India's revenue. It has higher margin. If you look at the recurring demand, it has 3 to 5 years per vehicle. Bucket number two, which is OEM supply. OEM stands for Original Equipment Manufacturer. Maruti, Tata Motors, Hyundai, they come to Apollo for the first fit tire for the new cars. It is actually a lower margin, but the volume business that builds the brand credibility. Bucket number three, which is Europe business. They own the Vredestein brand, that is a premium Dutch tire company. It is about 35% of the consolidated revenue, and this is where the problem it gets started. The raw materials are the key cost. Natural rubbers, synthetic rubbers, and the carbon black. When these prices spikes, obviously the margin will get collapsed, and that's exactly what happened here. So let's get into the profit and revenue story. Let's look at the last 10 years of the revenue first. In financial year of 16, they had 11,849 crores, and in financial year of 25, they got 26,123 crores. That is actually 12% of the compounded growth rate over 10 years. This seems to be genuine and organic growth. There is no asset sales, no one-time windfall which was inflating the numbers. Now let's talk about the profits. This is where it gets interesting here. This is where exactly the many retail investors, they do a panic selling here. In financial year of 24, the net profit, which is 1,722 crores. In financial year of 25, it is completely dropped to 1,121 crores. That is actually 35% of the fall. And then in Q1 financial year of 26, their quarterly net profit just 12 crores. That is actually 96% of the crash year on year. But here is what most people miss. This was a one-time charge related to closing their Netherlands plant. Look at the Q3 financial year of 26. Their profit is back to 471 crores. Their revenue just hit highest ever the quarterly levels at 7,743 crores. So the question is, was that fundamental is completely collapsed, or is that something like a temporary disruption? The answer is, when you look at the cash flow, that is completely clear. Let's do a cash flow test. I usually don't trust the profit and revenue alone. What I usually trust is operating cash flow. The company shows the profit, but there is no cash flow. It means like something is completely manipulated. When you look at the Apollo tires for the operating cash flow, that is completely in positive for last 10 years, which is not a single miss. In financial year of 24, when you look at the financial year of 24, the operating cash flow, which is 3,440 crores against the net profit of 1,722 crores. Here, the operating cash flow was actually double the reported profit. That is actually the mark of the real business. Now, let me run the three-part of cash flow test. This is I usually apply for every company. Rule number one, the operating cash flow, it should be in positive. When you look at for this particular stock, this is actually positive. And it is positive for every single year, not a single miss. When you look at the investing cash flow, this should be in negative. What exactly this means, like the company is investing in their business, And here it is completely okay and it is pass. And here it is completely negative. Rule number 3, the financing cash flow. This is where exactly this story gets really good. When you look at the financial year of 23 onwards, their financing cash flow, it has turned into negative. What exactly this means to us, like they are repaying the debts and they are not borrowing anymore. In financial year of 24 alone, 2,659 crores was completely repaid. When you look at these things, it seems like the cash flow, it seems to be good. And they do have a healthy cash flow structure. Now let's talk about the debt. This is where we need to worry about it. Apollo Tyres, they have a complicated debt history. Let me be honest about it. Between 2017 and 2021, looks like they borrowed aggressively when acquiring the Vredestein Europe business, building an Hungary plant, expanding the India's capacity, all those things. So the peak debt, which is like 7,334 crores in financial year of 21, and their debt to equity, it hit 0.64. That is actually a concern for this particular stock. But here is what they do have a separate good news from the bad one. What they did with that debt. Actually, they built in real assets. Their net block, it grew from 5,213 crores to 17,662 crores. And they started paying it back. In financial year of 25, the debt for this particular company, which is like 4,410 crores, and the debt to equity, which has dropped to 0.6 to 0.3. And when you look at the reserves, they do have 14,702 crores. That is actually 3.3x of total debt. By Q3 of financial year of 26, the net debt is completely down to 1,300 crores. Their net debt to EBITDA is 0.4x. That is near a debt-free territory for a manufacturing company. Now, what exactly happening now? They have just approved 5,800 crores of capital expenditure for Andhra Pradesh plant expansion. Obviously, this will temporarily increase the debt in financial year of 27. I do see this as a growth investment, but we have to watch this number in financial year of 27 and 28 results. If the debt is rising without operating cash flow rising, that is where we need to re-evaluate on this particular stock. Now let's talk about the promoter integrity check. This company is completely owned by Kanwar family, Ankar Kanwar and Dheeraj Kanwar. They have run this company over 40 years. The promoter holding, which is approximately 37%, which is stable and it is not reducing. And when you look at the promoter pledge, which is completely zero, not a single share is pledged. For me, the zero pledge is non-negotiable. If the promoter has a pledged shares, I don't touch that particular stock. On this particular company, it gets a clean pass here. So when you look at the dividend, they have paid every single year for last 10 years. Even in loss in financial year of 21, when the profit was just 350 crores, they paid a dividend. This is where exactly the promoter, it respects the retail investors. There is one checkered moment here. They attempted Cooper Tires acquisition in 2013. It was completely failed. It is failed after the legal battle. That is actually 12 years ago. The capital allocation, since then, it was completely disciplined. I am not holding it against them. Now let's talk about the valuation. The stock, which is trading at around 428 rupees to 400, is it a cheap? Let's see. Okay, now let's talk the numbers. In financial year of 25, the EPS was 17.7 rupees, but that is completely a depressed year. 429 rupees, the trailing PE, it looks like 24. There are 23 analysts in the market. They are anticipating on financial year of 26. The EPS, it could touch literally 24 rupees 0.62 paisa. That is actually 97% of the jump year on year. On financial year of 26, the estimated earning for 429 rupees to 400, we are paying just 17x for the forward PE. For a company like 12% of the revenue CAGR, zero pledge, net debt is zero, and India's fast growing manufacturing tire market, the 17 PE, which is something like it is not an expensive. When you compare this with an industrial PE, it has around 24. And the stock for this particular PE is nearly somewhere trading around like 17 to 17.8 in range. When you look at the price to book value for this particular stock is somewhere it is trading around 1.67 to 1.8. The book value is approximately 235 rupees per stock. This is not a value trap. Obviously, this is a value opportunity, but with certain known risk. If this kind of video is helpful for you, please do hit a like button. Do comment. I'm very happy to read all your comments. We'll see you on another good video. Till then,